Sherwin-Williams, ticker SHW on the NYSE. Founded in 1866 in Cleveland by Henry Sherwin and Edward Williams, the company introduced ready-mixed paint in 1875, a product that was genuinely revolutionary for an industry where everything was mixed by hand.
Today, Sherwin-Williams operates 4,900 company-owned paint stores across North America, more than any competitor by an extraordinary margin. No other paint company owns more than 300 dedicated retail locations.
The Cover the Earth trademark was registered in 1905, one of America's earliest. By 1990, the company had passed 1,000 company-owned stores. In 2016, it announced the $11.3 billion acquisition of Valspar, transforming Sherwin into a global industrial coatings competitor.
In 2023, Heidi Petz became president and CEO, the first female leader in Sherwin-Williams' 158-year history. A Michigan undergraduate and Fuqua MBA, she built her career at Clorox before joining Sherwin in 2012.
The business model has three segments: the Paint Stores Group at 55% of revenue, Performance Coatings at 31% serving industrial and packaging customers, and Consumer Brands at 14% supplying Lowe's and other home improvement retailers.
The financial profile is exceptional for a materials company. Gross margin is 47.8%. EBITDA margin is 22.4%. Return on invested capital runs at 18.6%, industry-leading by a wide margin.
85% of store revenue comes from professional painters, contractors who open invoiced accounts and rarely switch. Once a painter runs a Sherwin account, they reorder predictably for years. That professional painter lock-in is the foundation of the entire moat.
Sherwin-Williams has raised its dividend for 46 consecutive years, a dividend aristocrat since 1979. The payout has grown from $1.40 per share in 2015 to $3.60 in 2024, compounding through recessions, rate cycles, and raw material shocks.
On the competitive radar, Sherwin scores 98 on store network, 95 on professional painter loyalty, and 90 on pricing power, the highest marks of any coatings peer. No competitor is close on retail distribution or contractor relationships.
PPG Industries leads on aerospace coatings and geographic diversification. RPM International has a strong specialty coatings portfolio. Neither can replicate the 4,900-store distribution fortress that Sherwin has built over 158 years.
The store network spans over 120 countries through manufacturing and distribution, 100-plus manufacturing facilities globally, and 80 to 100 new store openings per year compound the structural advantage systematically.
Petz spent over a decade inside Sherwin, running the Consumer Brands segment and the Americas division before becoming COO and then CEO. Her brand management roots at Clorox give her a consumer demand orientation that complements the operational heritage of the Paint Stores Group.
Under her leadership, the margin expansion story has continued. Raw material cost normalization post-pandemic, combined with pricing discipline and operating leverage on the fixed cost store network, has driven EBITDA margin improvement year over year.
Sherwin-Williams has 4,900 paint stores, 46 consecutive dividend increases, and pricing power that professional painters pass to homeowners without question. The moat is a 158-year accumulation.
The housing remodeling demand cycle is the main growth driver to watch. When renovation activity picks up, Sherwin's professional painter volume accelerates. We dig into the numbers every quarter. Subscribe so you never miss a Charged Alpha deep dive.
Sherwin-Williams just dropped a quarter that paint store bulls have been waiting for. EPS of $2.68 against a $2.47 estimate, an 8.5% beat, with same-store sales in the Paint Stores Group turning positive for the first time in 5 quarters. We're breaking it all down today on Charged Alpha.
Sherwin-Williams traces its roots to Cleveland, Ohio, 1866, a company that essentially invented the modern paint industry. From standardized color formulas to the company-owned store model that still drives the business today. 158 years later, it's the largest paint and coatings company in the world by revenue.
And today's episode is about one central question. When the housing market unfreezes, what does that mean for a company where professional painters represent 85% of Paint Stores Group revenue? The Q1 numbers are giving us the first real evidence, and the answer matters for the 12-month investment thesis.
Here are the Q1 2026 headline numbers. Revenue of $5.31 billion against the $5.18 billion estimate, a 2.5% beat. EPS of $2.68 against $2.47. That's an 8.5% upside surprise. Both lines beat cleanly, and the stock responded with a 2.4% gain on the session.
The EPS beat came from two places: gross margin expansion and operating leverage on SG&A. Gross margin came in at 48.8%, up 60 basis points year over year. When you're running $5.3 billion in quarterly revenue, 60 basis points is roughly $32 million of incremental profit that flows almost entirely to the bottom line.
Revenue growth of 2.5% year over year looks modest on the surface, but context is everything here. This is against a housing backdrop where existing home sales are still running 15 to 20% below pre-rate hike levels. Paint Stores Group carried the beat, and the segment-level detail is where the real story lives.
The gross margin story is the key signal in Q1. 48.8% compares to 48.2% in Q1 2025. Pricing is holding, titanium dioxide costs are moderating, and SHW's mix is shifting toward higher margin Sherwin-Williams branded products versus private label. The pricing architecture that Heidi Petz prioritized is working exactly as designed.
At the segment level, Paint Stores Group, the company-owned store network serving professional contractors, delivered same-store sales of positive 3.2% year over year. That is the first positive quarter in 5 consecutive quarters of negative or flat readings. It signals that the repair and remodel freeze is beginning to thaw.
Performance coatings, the industrial, automotive, and general industrial coatings segment, held steady, with organic revenue roughly flat quarter over quarter. This segment is tied to global manufacturing activity, and with industrial production mixed globally, flat is fine. It's not a drag, and the margin profile for this segment is actually improving as Valspar integration synergies continue to flow through.
What drove gross margin expansion in Q1 specifically? 2 factors working together. First, pricing discipline. SHW implemented a mid-single-digit price increase in early 2026, and the professional channel absorbed it without meaningful volume resistance. Second, raw material tailwinds. Titanium dioxide costs peaked in 2022 and have been a consistent year-over-year tailwind for 2 years running.
On the tariff front, this was the dominant theme in the analyst Q&A. The concern is that tariffs on imported resins, pigments, and solvents raise costs and compress margins if SHW can't pass them through. Management's answer was direct. Professional painters don't shop on price. They shop on reliability and brand. Tariff costs are being passed through the professional channel without meaningful pushback.
SG&A came in at 22.2% of revenue versus 22.8% in the prior year period, 60 basis points of operating leverage on the cost structure. As revenue scales over a partially fixed cost base, each incremental dollar above trend is landing at approximately 30 cents of operating income. That leverage math compounds meaningfully in a revenue acceleration environment.
Operating income hit $931 million for the quarter, representing a 17.5% operating margin, up from 16.8% in Q1 2025. That's 70 basis points of operating margin expansion in a single quarter. Management guided for continued operating margin improvement across all 3 segments through FY 2026.
Net income came in at $700 million for the quarter, with EPS of $2.68 diluted over approximately 261 million shares. The share count has been declining through active buybacks, down from 272 million 2 years ago, which is adding roughly 3 cents per share annually from count reduction alone, independent of earnings growth.
Cash flow. Operating cash flow of $850 million for the quarter, capital expenditures of $175 million, yielding free cash flow of $675 million. For perspective, that's more free cash flow in a single Q1, historically the seasonally weakest quarter, than most consumer staples companies generate in an entire half year.
Balance sheet. SHW carries approximately $10.0 billion in net debt, primarily legacy from the Valspar acquisition. Net debt to EBITDA has improved to 2.4 times, down from the peak of 3.7 times immediately post-close. Deleveraging is steady and on track for the 2 times target by year-end. Below 2 times, history suggests a buyback expansion authorization follows.
FY 2026 guidance. Management reaffirmed and tightened the range, EPS of $11.65 to $12.05, with the midpoint implying roughly 7% growth over FY 2025. Revenue guidance of $23.5 to $24 billion. Gross margin expected above 49% for the full year. That's a meaningful step up, and if achieved, would be the highest annual gross margin in company history.
Let's talk about the housing setup, because it's the macro variable that determines whether SHW re-rates or stays range-bound. Existing home sales in Q1 2026 showed early stabilization, running at approximately 4.1 million annualized, still below the pre-pandemic pace of 5.3 million, but up meaningfully from the 2023 trough of 3.8 million.
Why does existing home sales volume matter so much to SHW? When a home sells, paint demand spikes. The seller repaints to list, the buyer updates after closing. The NAR estimates each existing home transaction generates approximately $900 in paint and coating spending. At 4 million annual transactions, each incremental million sales adds roughly $900 million in addressable paint spend to the market.
Professional painters are a lagging indicator for housing demand. They get commissioned 3 to 6 months after the sale decision is made. That means the positive same-store sales signal in Q1 2026 is reflecting decisions made in late 2025, just as the 30-year mortgage rate began easing from its peak above 8%. The lead time effect means Q2 and Q3 should be even stronger.
The repair and remodel market is actually a larger driver for SHW than new construction. Roughly 65% of Paint Stores Group volume comes from maintenance and remodeling work, not new builds. This makes SHW less cyclical than a pure new construction play. Deferred maintenance doesn't disappear, it simply delays. The pent-up R&R backlog from the 2024 freeze is a real demand tailwind.
Performance Coatings Group covers industrial maintenance, automotive original equipment, and general industrial finishing, the legacy Valspar business. International revenue held up better than expected, with Latin America up mid-single digits and Europe roughly flat, despite softness in continental manufacturing. The automotive refinish segment specifically is benefiting from higher collision repair volumes as aging vehicle fleets drive increased bodywork demand.
Let's talk valuation. At $3.32, SHW trades at 28 times the forward EPS projection of $11.85 for FY 2026. The 10-year historical average forward multiple for SHW is 32 times. So at 28 times, you're buying SHW at a 4-turn discount to its historical average. That 4-turn gap is exactly where the bull case starts and ends.
Why has the multiple compressed from 32 to 28? 2 reasons. First, the housing market freeze. Investors priced in cyclical demand deterioration, and they were correct to do so. Second, the Valspar debt load. At 2.4 times net debt to EBITDA, SHW lacks the buyback optionality of a net cash compounder. Both are known, quantifiable risks, which is precisely why the discount exists and persists.
Analyst Consensus. 18 analysts covering SHW, with a consensus price target of $3.65, representing 10% upside from current levels. 14 buys, 4 holds, 0 sells. The high target of $4.20 implies 27% upside. The bull case scenario if housing reaccelerates and gross margin crosses 50%. The low target of $2.95 gives you a sense of the structural floor.
Bull, rates fall, existing home sales approach 5 million annualized, gross margin crosses 50%, and SHW re-rates to 32 times forward. That puts target value at approximately $379. Bear, rates stay elevated above 7%, same-store sales stall, the multiple compresses to 24 times, that's approximately $280. The entire difference between those outcomes is Fed policy and the housing unlock.
The single most important metric for the investment thesis is Paint Stores Group same-store sales. This quarter, it came in at positive 3.2%, the first positive reading in 5 consecutive quarters. Consensus models 3 to 5% SSS for the full year. If SSS re-accelerates towards 6 to 8% as housing improves, the full-year EPS estimate gets revised upward, and the stock follows.
Why does same-store sales matter more than total revenue growth? Because store count additions are a known mechanical quantity. 80 to 100 new stores per year adds roughly 1% to revenue automatically. Same-store sales is the signal for underlying demand, entirely independent of the expansion math. Positive SSS on top of ongoing store openings is a compounding growth algorithm.
Options activity heading into Q1 results showed meaningful call positioning, specifically June 340 calls with approximately 800 contracts. That represents conviction that SHW reaches 340 by June expiration. Implied volatility at 22% is below the sector average, reflecting SHW's perceived status as a defensive quality compounder rather than a high beta cyclical play.
On insider activity, no open market purchases or sales post-earnings. CEO Heidi Petz holds shares from restricted stock unit grants awarded at her promotion to COO. Vanguard and BlackRock together represent over 20% of shares outstanding. Institutional ownership at 81% signals SHW is a core quality compounder holding for the largest institutional allocators, not a speculative position.
Petz has moved quickly since taking the CEO role in 2023. Her emphasis has been on pricing discipline, store-level productivity metrics, and operating margin expansion, not just top-line growth. The 48.8% gross margin this quarter is the direct output of that philosophy. Under the prior management regime, gross margins had stalled in the 46 to 47% band.
Catalyst 1. Mortgage rate normalization. The 30-year fixed averaged approximately 6.5% in Q1 2026, down from the peak above 8%, but still above the 5 to 5.5% range that historically unleashes latent homebuyer demand. Each 50 basis points of rate decline is estimated to add roughly 300,000 existing home sales annually, flowing directly into professional painter order volume.
Catalyst 2. New store openings maintaining the 80 to 100 per year pace. That's essentially one new Sherwin-Williams store opening every 3 to 4 days. Each new location reaches break-even volume in approximately 12 to 18 months, then generates mid-single-digit operating margins. The compounding effect of that store count adds roughly 1% to annual revenue, independent of any same-store sales improvement.
Catalyst 3. Gross margin crossing 50% for the first time in company history. At 48.8% in Q1, with guidance above 49% for the full year, SHW is within 2 quarters of that milestone threshold. The psychological and sentiment impact of a 50% gross margin for a materials company of this scale should not be underestimated. It reframes the quality narrative.
Catalyst 4. Balance sheet deleveraging unlocking expanded capital return. At 2.4 times net debt to EBITDA and generating approximately $2.5 billion in annual free cash flow, SHW can fully retire a full turn of leverage within 18 months. Below 2 times net debt to EBITDA, management has historically authorized buyback program expansions. That is the next capital return catalyst on the horizon.
Risk 1. Housing stays frozen. If the Fed pivots slower than expected and mortgage rates remain above 7% through the back half of 2026, existing home sales stagnate, professional painter demand stays subdued, and the same-store sales momentum we saw in Q1 stalls or reverses. In that scenario, the 28 times forward multiple could compress to 24 to 25 times, a meaningful re-rating downward.
Risk 2. Raw material cost rebound. Titanium dioxide, the primary white pigment in architectural paint, has been a 2-year tailwind as post-COVID supply chains normalized. Tariff escalation on Chinese TiO2 imports, or a global demand spike driven by infrastructure spending, would reverse that tailwind. A 100 basis point gross margin decline at SHW's revenue scale equals over $230 million in lost annual profit.
Risk 3. Rivals are not standing still. PPG and RPM, SHW's primary rivals in architectural and industrial coatings, have both been gaining shelf space in big box retail and investing in their professional contractor outreach programs. SHW's moat is enormous, but rivals are actively working to erode the consumer and contractor channel edges where switching costs are lowest.
But let's be precise about the competitive moat. Professional painters have a singular relationship with their paint brand. They've staked their reputation on product quality and consistency. Switching brands for $2 per gallon of savings introduces failure risk on a $1,500 job. SHW's 85% professional revenue share didn't accumulate by accident. It happened through consistent product performance over decades.
The store network compounds the professional moat. When a contractor runs out of a specific custom-tinted formula mid-job at 7 in the morning, the only answer that works is the brand that's available within driving distance. SHW's density advantage, nearly 5,000 stores across North America, is not something any competitor can replicate without a multi-decade build-out and billions in real estate capital.
On capital return, the regular dividend currently yields approximately 1.2% at this price. That sounds modest, but the dividend growth rate of roughly 12% annually over the past decade means yield on cost for long-term holders is significantly higher. Adding the buyback yield of approximately 2.3%, total capital return at the current pace runs closer to 3.5% before EPS growth.
The total return framework for SHW, 1.2% dividend yield, 2.3% from buybacks at current pace, and an expected 8 to 10% annual EPS growth rate, puts the base case annual total return in the 11 to 13% range, before any multiple expansion from the 28 times current multiple, reverting toward the 32 times historical average.
Back to the tariff question, because it dominated the earnings call Q&A. SHW sources some resins and pigments from international suppliers exposed to tariff risk. Management's specific answer: the professional channel has demonstrated pricing power in 2022 and 2023, when raw material inflation ran double digits. They passed those cost increases through with minimal volume loss. The same playbook is available for tariff-driven cost pressure.
The economics of why the professional channel absorbs price increases. A contractor billing $1,500 for a painting job is not price sensitive to a $5 increase in the cost of a gallon of paint. That incremental material cost is 40 to 60 cents on a labor-intensive job. The contractor passes it to the homeowner. SHW's pricing power is structurally asymmetric because of where it sits in the value chain.
The repair and remodel cycle has a specific dynamic worth understanding. Deferred maintenance creates a demand backlog that is real, not lost. Homeowners who postponed painting projects in 2024 and 2025, waiting out economic uncertainty, still have those projects in the queue. When affordability and sentiment improve, that pent-up demand releases into the market rapidly. SHW is positioned to capture the first wave.
International Performance Coatings represents roughly 31% of SHW's revenue and operates in 120-plus countries across industrial maintenance, automotive finishing, and architectural coatings. The long-term international opportunity is meaningful. Infrastructure investment in Asia and Latin America drives industrial coatings demand, independent of U.S. housing. Brazil and Mexico were called out specifically as strong growth markets in the Q1 commentary.
Return on invested capital at 18.6% is one of the highest in the materials sector. It reflects the asset-light model of company-owned stores versus a manufacturing-heavy capital structure. The Valspar acquisition diluted ROI from above 20% by adding significant goodwill to the balance sheet. As net debt falls from 2.4 toward 2 times and goodwill amortizes, expect ROI recovery back toward 20% and above.
What does a buy look like for SHW at current levels? At 28 times forward earnings with a catalyst path toward 32 times as housing normalizes, the math is straightforward. $11.85 in FY 2026 EPS times 32 equals approximately $379. That's 14% from here in the base case, before dividends and buybacks. For a quality compounder, that's a reasonable risk-reward setup.
The three numbers to watch for Q2 2026. First, Paint Stores Group same-store sales needs to hold above 3%, ideally accelerate toward 5% to maintain the recovery narrative. Second, gross margin needs to push above 49% to validate the full-year guidance. Third, new store count, confirming the 80 to 100 annual pace is on track. All three in line, and the stock moves higher.
For Q2 2026 specifically, Consensus is modeling EPS of $3.45 versus $3.01 in Q2 2025, a 14.5% year-over-year growth rate expectation. Revenue consensus sits at approximately $6.1 billion. Q2 is seasonally the strongest quarter for architectural paint as spring selling season peaks. The setup for a beat is real if the SSS acceleration continues.
The housing cycle tailwind trade is the cleanest way to frame SHW's investment thesis right now. You're getting the world's best paint franchise at a 28 times multiple that has been compressed by a housing freeze that appears to be thawing. The same-store sales positive print in Q1 is your first data confirmation that the thesis is beginning to play out in the reported numbers.
At 28 times forward earnings for a company with 85% professional revenue, a 49% gross margin trajectory, 18.6% ROIC, 46 consecutive dividend increases, and a store network that took 158 years to accumulate, you are paying a discount to intrinsic value if housing normalizes to anywhere close to historical transaction volumes.
Bull case target. If SHW re-rates to 32 times the FY 2026 EPS midpoint of $11.85, fair value is approximately $379, roughly 14% from current levels, before any upward EPS revision that would come with same-store sales acceleration. The maximum upside scenario at 35 times forward, the peak historical multiple, is north of $415.
Bear case. If housing truly stays frozen, EPS comes in at the low end of guidance, $11.65, and the multiple compresses to 24 times as investors rotate out of housing-sensitive names. That implies roughly $280 per share, about 15% downside from current levels. The bear case is real if the Fed holds higher for longer into late 2026.
Why are we constructive here? Because Q1 results provide the first hard evidence that the same-store sales cycle is turning. The gross margin trajectory is intact above the full-year forecast. The balance sheet is deleveraging on schedule toward 2 times, and you're buying that setup at a 4-turn discount to the historical average multiple. The risk-reward at 28 times skews to the upside.
We'll leave you with a quote from CEO Heidi Petz from the Q1 2026 earnings call. She said, "The positive same-store sales performance in our Paint Stores Group reflects the underlying resilience of our professional customer base and gives us confidence in the demand recovery that our full-year guidance anticipates." That's the signal. That's the thesis. We'll see you next time on Charged Alpha.
This content is for informational and entertainment purposes only and does not constitute financial advice. All investments carry risk, including the potential loss of principal. Past performance is not indicative of future results. Always consult a licensed financial advisor before making investment decisions. Charged Alpha is not a registered investment advisor.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.